everybody, and welcome today to the webinar. I'm going to go ahead and try to find out here. Okay, so hopefully everybody can hear me okay. I know I had issues last time around, but I think I did what was needed here with GoToWebinar this time around to be able to be in good shape. So today we're going to dive in and talk a little bit about financing. A lot of stuff's changed here into 2017. And by the way, if any of you can't hear me, can't see my screen, etc., in the chat or questions, or in the chat section, just go ahead and type in and let me know. Otherwise, I'm going to go ahead and move forward. So today, the reason we're doing the webinar today on financing is because, Dex on our financing side had said, hey, I've got a bunch of new stuff that's going on, and I want to make sure that the partners know about it. So I said, no problem. I'll do a webinar today to be able to go over this with them. Some of the stuff you may already know because some of it's relative to programs we've had that haven't had a bunch of changes, and a lot of this stuff is going to be stuff that is fairly new. That maybe you guys don't know about, a deeper dive into revenue lending, things like that, to give you an even greater idea of how to qualify customers, etc. But the bottom line is, what we're going to talk about today is qualifying your customers so you know who can get a loan, who can't, and you have as many details as you could possibly get on our core funding programs that are out there, including rates, terms, how much money you can earn on these programs, etc., etc., etc. So that being said, let's jump in. Some of these have graphics. Some have the same graphics on the same slide. Don't judge me based on the graphics. So you guys have obviously heard by now, and if you haven't, then I highly recommend you go back through our step-by-step partner training, go back through our direct funding training if you're executive, that there's 3 ways to qualify a customer: cash flow, credit, and collateral. If they have good credit, they can get a loan, or if they have cash flow, they can get a loan, or if they have a collateral, they can get a loan. What you and I do that's different is that we can lend people money based on one of these. Big banks need all 3 of these. It's that simple. Any other funding source out there that might be your quote-unquote competition, they typically only offer one of these. There are people that offer revenue lending loans. There are people that offer the unsecured program. There are even people out there that offer some of the collateral-based programs. But typically the funding sources that are our competition per se are only offering one of these 3, where all these programs combined that we're going to talk about today is what really separates and makes us different. Because if somebody has cash flow and good credit, we can get them 2 kinds of financing. If they have all 3 of these, we can get them 3 types of financing, and we often do. But what it takes to qualify a customer is really simply this: qualifying based on credit, cash flow, or collateral. Do they have one of those 3? Yes. Well, then they're probably a good candidate for financing. If they don't, then they're not. So let's dive in and talk a little bit more. So again, when I talk about cash flow financing, there's really 2 different types. There's financing that's based on them actually using their bank statements to verify, and this is revenue lending. This is merchant cash advances. The only real difference between these 2 is merchant cash advances only look at the credit card deposits on a bank statement. Revenue financing looks at the overall revenue of the actual company that's going through the bank account, not just deposits from credit card transactions. Tax returns. You can get alternative SBA loans, private money loans, even credit lines are all available for a company that shows tax returns to verify their revenue, and that has revenue that increases from year to year and some kind of net profit. Now, we're going to be talking about all these today, especially revenue financing in depth, but that kind of gives you an idea. If somebody wants to get money and the strength that they have is they have consistent cash flow, how do they verify the cash flow? Do they have years of tax returns that show some kind of profit? If so, man, does that open up some powerful options for them. In most cases, they don't, and they still have some good options, but not as good as if they were able to provide the tax returns. So revenue lending, merchant cash advance. This is the fastest type of financing that exists in the world today. On average, we see these close in 3 to 7 days. On average. What does that mean? Well, we literally have seen multiple times where we funded somebody the next day, and it was actually usually to cover their payroll. They realized they didn't have enough money in the bank to cover their payroll. They're borrowing money to come in and get the payroll. We've got it funded in 24 hours. They literally sent the deal in on Monday, and on Tuesday we got them funded. But on average, I say 3 to 7 days. How long any deal takes to fund depends on you and your customer. how long does it take them to get us what we need? If we get them an application to sign, do they get it to us back in an hour or a day? If we ask them for their bank statements, do they send them over within an hour or a day? That's going to determine how long any funding deal takes. But the funding on these is faster than any other one. It's the only kind of funding that's out there that really somebody can get within 24, 48 hours. It's easy money. They don't need collateral, and there really are no credit score requirements. Yes, some lenders want a 500 credit score. We've got just equally as many lenders that don't even pull personal credit. They don't even look at it. Guys, what they care about here is bank account management. Let me see if I have that next. This is what they care about. How does somebody manage their bank account? If you think about what happens with revenue lending, they're taking their payment directly out of the business's bank account. So the number one question on their mind, does this business, based on their bank account, have the money to take if we need to take it? And if you think about that one question, it tells you everything. It determines the rate the customer is going to pay. It determines how much money they're going to get. It determines the term and how long they're going to get to pay the money back based on answering the one question. If we look at the bank statements, does it reflect that the customer can actually pay back the loan? Meaning, do they have money at the end of the month on the statements? Do they have a bunch of non-sufficient funds, meaning they're constantly overdrawing the account? Do they have more money going out than they have going in? These are all indicators that people are struggling to pay their existing bills. But then if you look at a business that has a positive balance at the end of each month, that doesn't have any or very few non-sufficient funds, these are people that manage their bank account responsibly, have the money to pay back the loan. That's the main thing we're looking at. Do they have consistent deposits? We don't want a real estate agent or an investor on this deal that only does 1 or 2 transactions in a month. We need it to be consistent, because if they only do 1 or 2 and we remove one of the 2, well, then we're going to have a problem with paying back the loan. Are they stable? Are they positive? Okay, loan amounts up to 12% of annual revenue. Okay, so that means that if you have somebody, and I like to say this at 10% because it's just easy math. If I have somebody that does $500,000 a year in revenue, well, 10% of that's 50 grand. So that's how much they're going to get. If I have somebody that does 120,000 a month in revenue or a year in revenue, well, that's $12,000. If they have $1 million in revenue, well, that's $100,000. This affects you guys because if you're part of our executive program, you're getting paid funding on these deals. You can make 3% on this deal. So if you have a $10,000 deal, you make $300. If you have a $100,000 deal, you make $3,000. You have a $500,000 deal, you make $15,000. And yes, we have that high of payouts. So how can you determine that? Deal with companies that have more revenue. The higher the revenue, the more money they can get with this program, the more money they can get, the happier they are, and the more money you can get paid as well. So paybacks on this are daily, normal, but we also do weekly and even monthly paybacks. This is a really big deal for you guys, and I'll tell you why. We have a lot of people that don't like these loans because they deduct money every single day. Well, in those scenarios, we flip them to a weekly payback if the risk is low enough. If you have somebody that has 500 credit score, 20 NSFs, and they barely get approved, they're probably not going to get a weekly or monthly payback because they're too high risk. But if you have somebody that's an average or low risk, well, then they're going to have more options, including weekly payback or monthly payback, where every Friday they deduct the money, or once a month they deduct the money like a normal loan. But those weekly and monthly options become available for somebody the lower the risk that they actually are. So this is pretty short-term financing. I say 6 to 18 months. We've seen a lot of them go as low as 3 to 9 months when they're first getting their very first advance. And then we've seen the lower risk ones go as far out as 3 years. That's pretty strong. A 3-year payback is pretty equivalent to what we would see with SBA or alternative SBA. Myself, that's why I love this program. I love it because it's actually a really good program for people with low risk. If you have somebody with good credit scores, good time in business, really good bank management, well, then this person's going to get a pretty low rate and good terms offered to them. If you have somebody that's really high risk, well, they're going to pay more money because of the risk, but we can still help the high risk people. It's kind of a catch-all type of program. And again, they could even get second advances. So for example, we get them a first loan for 100 grand. There's even companies that will go behind that first loan and give them another 10 or 20,000 with a second advance. There's even the same bank that will give them a second advance through a credit line in some cases. So it's not uncommon to get somebody 10 or 12% of their revenue in one loan and then be able to possibly get them a second advance or a line of credit if their risk is low enough to be able to do so. Loan amounts up to $500,000. Yes, we have funded for $500,000 deals. Surprisingly, it's not that uncommon. We actually deal with at least usually 1, 2, 3, or more deals in a month that are $250,000 to $500,000 in money. So that being said, this is definitely practical to get loans to this point. This is about a $5 million company to be able to get $500,000. Over 70%, it's now up to about 75% do come back and get more money. Very important to listen to this, guys, for you and for your customer. What this means is it means that when they pay down half of their loan amount, so let's look at a term of 6 months. Let's say somebody gets a loan for 6 months. Well, 3 months into that, they've paid half of it off, halfway through the term. What's going to happen is they're going to be offered more money by the lender. The lender's going to say, hey, look, you were originally given 50 grand for 6 months. 3 months have passed. You can get more money. Send us your most recent bank statement. Usually singular, not plural. I just want to see last month's. If last month's reflects good revenue, good management, etc., well, then they may come in and go, look, this is what we're going to do. We're going to go ahead and give you an additional 50 grand. So now you're going to have, you've got 50,000 you were lent, you paid off 25, we'll give you another 50. So now we'll pay off your 25 and now you've got one loan for 75, for example. And by the way, Mr. Customer, instead of going 6 months, this one we're going to go 12 or 18. The longer term and the lower rate, they usually offer them lower interest rates at that point, mean that somebody can actually get a lot more money and their payments will not change very much. This is why most people come back and get more and more and more of these advances. Because what happens is the second time around, the term gets longer, the rate gets lower, the amount they pay back or pay to the lender as a fee gets lower. So because of that, somebody might have a weekly payment of, let's say, $1,200 or let's say $1,000, and then all of a sudden they're able to get another 60 grand and their payment only goes up $200 a week. Well, no big deal. An extra $200 a week, you're getting an extra $60,000 advance. This is why 75% of our customers come back. Why you should care? Because if you're part of executive and you're getting paid on this, then guys, you get paid on these renewals as well. So if you we have partners that literally have received 10 payouts on one funded deal. We funded the deal, the customer renewed, the partner gets paid. The customer renews, the partner gets paid. The customer renews, the partner gets paid. So the beauty of this is that because we have the relationships we have with our lenders, a lot of lenders won't do this. When the customer renews, we get paid. When we get paid, you get paid. So it helps your customer because after we go through the first loan, they're able to easily get more money in the future. It helps you because it's almost like recurring money for you. If you bring in enough of these deals, they continue to fund, and as they refund and redo a new loan, you get commissions paid on that like you would on the first one. Now, we don't get paid the exact same commissions we do on the first one. It's usually less money because they're getting less of a rate and term they're paying. That's what's making them go with it. But you're still getting consistent money every time they renew, which is awesome. 10 to 45% is the interest rate range. Pretty big range, right? Well, the rate range is big because the risk is big. You know, we deal with low risk, we deal with high risk. So I've actually seen people as low as 7 and 8% on these loans. I've seen people over 45%. So what affects the risk? Time in business, the industry they're in, personal credit quality sometimes if it's looked at, the bank account management, the ending balances they have, all those things affect the risk. And again, even if you're dealing with the high-risk industry like financial services, like we fund a lot of credit repair businesses. They're high risk. Most lenders won't touch them. But we do touch them, and I've seen really good rates with credit repair because they were low risk in these other factors, as a matter of fact. So again, rates are all over the board. It depends on somebody's risk, but I will tell you something interesting. usually 9.9 out of 10 times, the customer voluntarily chooses a higher rate. Why would they choose a higher rate? Because the lender usually produces three options for them that our finance officers go over. And they usually consist of longer terms and higher rate. So a customer can get a lower rate if they're willing to accept a lesser term, which means their payments are higher. So even though the rate is lower, their payments are higher because the lender's giving them a shorter term. So for example, a customer might have an option of 6, 12, or 18-month payback, where the 6-month term is a low rate. Maybe it's 8%. Maybe the 12-month term is 15%. Maybe the 18-month term is 25%. Well, 9.9 out of 10 times the customer chooses to pay more rate in exchange for higher payback terms or for longer payback time. And that's because customers are typically choosing monthly payment. They want the lowest payment. They don't care if the rate's more, if the longer term is longer, because their payments are less. Fees and interest are 100% tax deductible. I love this about running a business. I don't really care about fees on much of anything, as long as I know I'm not getting gouged. If it's based on risk, it's based on risk. If I'm high risk, I pay for the high risk. I understand lending. I get it. But it's 100% tax deductible anyway. So if the payment's affordable and doesn't make sense, well, then in that case, it makes sense to go, because no matter whether they're paying 10 or 45%, they're getting it all back on their taxes anyways. Okay, affordability is what matters most. They can't currently be in trouble if the lender does pull their credit. Are they in a BK? Do they have really recent tax liens? That could be a disqualifier. Not much on personal credit disqualifies people from what we've seen beyond those things. They've got to have $120,000 a year in revenue. And remember, even then, that's only about $10,000 in advance. It's not going to pay you a lot. It's not going to get them a lot. But again, you've heard stories before where I talk about people that got $8,000 or $10,000 for their first advance. They used it to grow their business. Then their second advance they got 3 or 6 months later was 40 grand, 50 grand. And we've got customers that have got 10 or 12 of those advances so far, where they started really low at 8 or 10 grand, proved themselves, and then they continued to get more and more approvals at higher amounts. And again, our partners continue to get paid. So again, some banks will go as low as 5 grand if they have compensating factors like really good bank account management, really good time in business. But 10 grand a month in revenue is the rule of thumb with qualification. They need to be in business 12 months. We do have some lenders, and this is wrong, this line here, but we do have some lenders that'll do this if they've only been in business 6 months. But guys, you're going to run into so few companies that have 10,000 a month in revenue and have been in business less than 6 months. It just doesn't happen very often at all. You're not going to run into a lot of people that have been in business 3 years and only make 5 grand a month in revenue. So there are exceptions here with compensating factors. The beautiful thing about our finance team is that we do so much volume, we often get exceptions when others can't. I just got off our finance team meeting, and Craig was talking about one of those exact same scenarios where, we got the loan denied, we pulled our weight, we got it through a few different lenders to get it done. The customer's getting 22 grand in advance when nobody else could fund them. And now what will happen is 3 months from now, she's going to come back and she's probably going to get 40 or 50,000 on her second advance once she proves herself. That's the way these deals work, guys. The first one is usually the harder one to qualify for, not hard, but harder. And then after they prove themselves at that first advance and shown they could deal with this kind of loan, then the lenders willfully want them to get more money. We have them, the lender will call and say, hey, look, you're ready for another advance. The customer says, yep, I'm ready. Here you go. Here's my banks. And the lender says, you qualify for another 60 grand. And the customer says, let me think about it. That lender's pretty much going to be putting a lot of urgency on them over the days to come to move forward. They want to work with customers that have proven that they can pay these. They're going to have more than 6 deposits monthly on their bank account. They need to have, again, consistent deposits. They can't have any non-sufficient funds over 10. They need to have less than 10 non-sufficient funds. They need to have a positive bank balance at the end of each month. Again, common sense, showing they have the money to actually pay the loan back. And these can pay you about 3 points. Sometimes we get paid more, and we even have incentives and bonuses where you get paid 4 points. And when I talk about this, I'm talking talking about the executive program. If you haven't heard of executive, I'll be emailing some information out. You can also go to creditsuite.com/executive. It's our new subscription that replaced everything else. In order to earn money on direct funding, you used to have to pay us $299 a month. We got rid of that. You used to have to pay $39 for Platinum Partner, $99 for Silver. We had literally $440 a month worth of subscriptions that some customers were paying. We got rid of it all. We put it all under a $99 executive. Anybody that's in there can earn money on all these funding programs. So that's why I'm telling you how much money you can earn on each of these. I want you to know the earning potential on each potential program so you know the kind of money you could make as well as what actually works for your customers. So this is new. I've never taught on this before, and this is something that I think you're going to want to pay special attention to, because the question is what determines this risk? What makes the guy 10% versus 45%? Well, I'll tell you. They kind of break it down into 3 different tiers. Tier 1, time in business over 5 years. An owner that has a FICO score that's not afraid to show their credit has a 650 score. They've got basically $250,000 a year in revenue, about 20,000 monthly gross, with 12 revenue deposits a month. Remember, we talked about that they needed to have, I think, at least 12. And this is, if they have over 12, they're in tier 1. They don't have any non-sufficient funds or overdrafts. That's going to be somebody that's going to fall into a tier 1, a very low risk. They're going to get low rates. They're going to get longer terms. They're going to get daily and weekly payment options, possibly even monthly. They're going to have no UCC filing under $150,000, which means the loan will not even show as a UCC filing on the credit report. And they have the ability to request more money, which this kind of cut off here a little bit, but that's okay. No UCC filing isn't a huge benefit. The UCC filings don't directly or adversely affect the credit score, but low rates, long terms, daily and weekly payback, those things are pretty big benefits for the lower risk. Then there's tier 2, time in business over 2 years, FICO over 600, consistent revenue of 10,000 monthly with minimum of 8 deposits a month. Non-sufficient note overdrafts affect the approval process case by case, so they can have some and still fit into tier 2. And the benefit is it's easier to qualify, able to fund. Let me change this for a second, guys. Let me do this for a second. Give me a second here. I'm going to go ahead and delete this, and delete this, and delete this. And then I'm going to redo this from current slide. Boom, here we go. Okay, so on this first one, this was cut off. Able to request no personal guarantee with tier 1. That's a big deal, right, guys? So we've all heard about this personal guarantee. Everybody asks, what about getting loans with no personal guarantee? With revenue lending, it is possible. I'm not telling you it's guaranteed at all. But what I'm telling you is that with tier 1, over 5 years in business, over 650 score, 20 grand a month in deposits, no non-sufficient funds, they get lower rates, longer terms, daily and weekly payback options, no UCC filing on the credit report, and the ability to request no personal guarantee. And if they're no low risk, they're probably going to get approved for it. We just talked about tier 1. Time in business over 2 years, over 600 score, over 10,000 a month in deposits. Some non-sufficient funds based on a case-to-case basis. Benefit easier to qualify for, able to fund amounts equal to the monthly revenue, 10-month or 6-month average with very low documentation required to close. So not as much docs needed to close, but this is what's nice. Usually they're going to go by the last 3 months average bank statements. They want to see 6, but they go off the last 3. This tier lets them go off 6. So let's say they had a bunch of deposits that were good 5 months ago and 6 months ago, and the last 3 haven't been as good. Well, then we're going to be able to go off the 6-month average with the tier 2 risk factor, which is going to help us get better terms and, again, get more money. Tier 3, time in business greater than 6 months. Owner's FICO over 500, consistent deposits of 10,000 a month with minimum of 8 deposits a month, or revenue of 10 grand a month, 8 deposits a month. And with this one, they're able to access working capital even when they usually can't get approved. But they're going to pay a higher rate. They're going to pay a higher term. They're going to have a personal guarantee. There's going to be a UCC filing on their credit report. Not a bad thing. It's just others are going to know they have a loan. So, and it doesn't help build their business credit necessarily. So these are tier 3. And again, this is why that rate ranges from 10 to 45%. This is why the term ranges from 3 months to 3 years. Because again, if you have somebody that's lower risk, they get a longer term lower rate, and this is actually a really good loan for them. But a lot of the ones you and I see are tier 3. They are high risk because they don't manage their bank account responsibly. Their credit's trashed, et cetera, et cetera. Those people can still get approved, but they're going to pay more for this kind of financing. So I go over this with you, and I think it's important because sometimes we think of revenue lending as kind of a bad, high risk, high rate product. But the reality is what we see over here is a completely different story. We see people with very good credit and very good businesses that do lots of revenue, sometimes even millions in revenue. And I think 3, 4, 5, 6 million plus we've seen. We've even seen higher than that. And they manage their bank accounts very responsibly, but they want the fast, easy money without going through all the headaches of SBA, and these lenders want that customer. So they give them the longer terms, they give them lower rates competitive to SBA, so the customer gets the benefits of fast, easy funding with little income doc, and they also get the benefit of having great terms. But then you're tier 3 or higher risk, but they can still get approved where they couldn't get approved elsewhere. Now, additional details. Okay, industry restrictions apply. There's a lot of restricted industries that are out there that will get somebody disqualified. And I was going to put this in here actually, and I forgot to. So let me see if I can pull that up real quick here and figure this out. Guide to getting business credit. I'm going to go ahead and just see if I can pull up another PowerPoint real quick. I want to see. Okay, so I actually do have some of these industry restrictions on this. So here's some restricted industry. These will almost get somebody an immediate decline. Ammunition, weapons sales, bail bonds, check cashing agencies, energy, oil trading, petroleum extraction or production, finance, banks. Okay, bank holding companies, loan brokers, commodity brokers, security brokers, mortgage bankers, mortgage companies, bail bonds, mutual fund, credit repair. So a lot of people think here that they are high risk because of credit repair. Well, you're in finance. That's the problem. When you deal with consumer credit, you're in finance. That's why you're high risk, same as mortgage brokers are. Gaming or gambling, loans for speculative purchases of securities or goods, pawn shops, political campaigns, public administrations like federal government. That's funny that the federal government's high risk. It's probably makes a lot of sense too. X-rated products. These will get you declined immediately. Now we can sometimes get past this and get companies approved. We have, like I said, with credit repair. These are restricted. More stringent underwriting guidelines don't necessarily mean a solid decline. Agricultural, forest products, auto recreational vehicle sales, courier sales, computer and software related services, dry cleaning, entertainment, general contractors, gas stations, healthcare, special trade contractors, hotels, motels, jewelry, limousine, long distance over the road, mobile home sales, phone sales, real estate agents, brokers, real estate developers, real estate investors isn't on there, but I'll add it, restaurants or drinking establishments, software or programming companies, taxi cabs. So a lot of high risk. These will just have more stringent guidelines, don't necessarily need an immediate decline. Loans are based on bank accounts, not total revenue if operating more than one business account. Okay, so again, we have businesses that have multiple bank accounts. The problem with that is they're only going to go off one bank account because they're only going to deduct payments from one bank account. What they care about, remember, is getting the payment when they go to get the payment. So if we've got somebody here that doesn't have the money in their bank account to take, they don't have the money in the bank account to take. So if you've got somebody that has multiple bank accounts, well then again, that becomes a problem because what's going to happen is then in that case, they're only then going to qualify for what's going through that one bank account. No prepayment penalties, so they can pay it off early and they don't have any kind of fee if they decide to do that. Depending on which tier, and we just talked about the 3, huge discounts off interest at time of early payoff. So if they get something and they pay it off early, they won't pay all that interest that they maybe would have had to pay. They can get approval in 24 hours with 1-page application, 6 months bank statements. This is the key, guys. If you want a customer to get funding quickly, then get the application or have them get the application to the FO quickly, the FO CFO, finance officer, and get the bank statements all pages quickly. This is so simple to get. I can go to Regions and Wells Fargo where I bank, a Bank of America as well, almost all of them. I can easily download PDF bank statements for 6 months within 2 minutes, and then I have them all right there. So it's very easy to get these now from online bank accounts. They get funded in as little as 72 hours with minimal closing documentation. Again, we see them sometimes happen even faster, especially with renewals. Not every lender reports to business credit, but some do. Some lenders actually will help somebody build business credit with this program. So again, pretty cool. Somebody can actually build business credit and get no PG, but please keep in mind, there's a reason I showed you those 3 tiers. Don't come in and go to the finance officers. Ty said this guy's going to get business credit reporting and no PG. It is possible with some lenders, but as you see by the tiers, it's based on risk, guys. So if we have a higher risk or middle risk, it's not going to work. If we have somebody that's low risk, then these type of things become available, and they say, hey, look, here's my banks, here's my credit, I have great credit, I have good bank account management. I'd like to see if I can get this with no PG, or I'd like to get this with a bank that can report to the business credit reporting agency. Then those things become practical with the lower risk, better tiers. Must have credit of all owners with 20% or more ownership. So if anybody owns more than 20% of the business, they need to supply their own credit. And credit lines are available with this program as well. The reason credit lines are available with some lenders is the lenders weren't fond of somebody else doing a second right behind them, so they just give the customer a second. They give them a $100,000 advance, and then they give them a $20,000 credit line. And in doing so, the customer doesn't need to go to another source to get the second advance, which, by the way, we have lenders that do first advances, second advances, third advances, as well as some do the credit lines. This is why we work with such a high volume of lenders. So that really wraps up revenue lending. A lot of details, but this is the #1 program a lot of your customers will deal with because a lot of them have credit issues. So this is an easy program for them to qualify for. But we also talked about what happens if they have tax returns to verify the revenue and not bank statements. Well, funds that come from investors, alternative lenders are also available out there. We have hedge funds that fund deals, for example. No collateral is required, unlike with SBA loans. You can get 50 grand up to $500,000 with these kind of programs, and they can get loans and credit lines with these kind of programs. 500,000 are available too. It's just longer closing times. Your deals over 500,000, $1 million, we close them. Sometimes they take 3, 6 months or longer to close because the process is really long, and then you might get all the way to the end and the investor hedge fund doesn't want the deal. Something crazy happens where the deal's got to move somewhere else. So it's a very long process with some of these deals, especially over $500,000. Nonprofits can qualify. 2 to 4 year loan terms I put, but sometimes they're available even longer. Sometimes even credit lines are available, and the rates, as you can see, are very, very affordable. 8 to 25%, depends on the risk of the deal. Most people are on the lower end of the spectrum because they wouldn't be able to qualify if they're higher risk for this program to begin with. Okay, they are mostly looking at profit margins on the tax returns. They want to see tax returns with revenue that's increasing from year to year, and they also want to see profits, net profits. Some lenders lend directly based on the net profit that the company has. Some lenders, we've seen 5x, 10x times the amount of net profit. They just want to see that the business is growing, that the revenues are growing, that the company's claiming some kind of profits, not losses every year. And you usually have to have pretty good credit with this program, about 700 credit scores. So remember, revenue lending credit doesn't matter. Bank statements verify income. With these kind of programs, they're going to need tax returns. They're going to need good credit scores. 700 I put here, maybe 680, maybe 690, but they need good credit. So when you have people, and everybody does, right? Everybody says, I want a 4 or 5 year loan at 9%, 8%. No problem. We can easily do that. You need to be able to go full doc and verify your income, at least with tax returns. Often a balance sheet, P&L, etc. are going to be needed. And you need to have really good credit, showing you've got a good track history for paying back your other bills. If you don't have those, nobody's going to get credit lines. Nobody's going to get long-term low-rate loans, period. And guys, it's kind of common sense. It makes sense. Look, if you want to get a long-term low-rate loan, then that means you are low risk. What defines low risk? Good personal credit reflecting you've paid your bills in the past historically as agreed, and tax returns showing your business is growing and showing that you're making profits. If your business is profitable and you've shown that you've got a good payment history in the past on the personal side, you can qualify. If you don't have one of those, well, then you probably want to consider one of the other funding options we're going to go over today. Good credit and financials are needed for approval. More options are becoming available with tax returns as well. We got a lot of these weird options. We've got one where they can get approved with a 650 or a 660 credit score if 5% of the funds come from their peers. They raise 5% of the loan amount from people they know, and then the lender gives them 95% loan on the rest of the money, even with average credit, a 650 credit score or more, because they have tax returns that make sense. So there's a lot of options if we have both of these. Some options if we have one. If we've got somebody that doesn't have a 700 score but a 650 and really good tax returns, that's a fundable deal in some cases, just not with this many lenders. So a lot of these options are available. These usually pay you about a half a point. We make a point, we split it with you, you make about a half a point. Doesn't seem like a lot, but I mentioned another one that, for example, another funding that it's $135,000 payout for the partner because the loan amount's so high. You got to think, I mean, on $1 million loan, guys, 1% can become a lot of money. On a $10 million loan, for example, that 1% can become a lot of money, or that 0.5% could pay you $50,000 on that deal. But again, these really big deals take a lot of time and a lot of headache to close, I can tell you from experience. So revenue lending is a much faster, easier way to make the money, but you can still earn money, really good money on these deals because again, the loan amounts are usually much higher. SBA, we deal with them. They're hard to qualify because you've got to have 2 years of personal business financials and 2 years tax returns. I think SBA says they want 620 credit scores, but we've seen 780s decline. They need to have really good personal credit with no derogs, positive tax returns that show profits and good revenue, and they're going to need collateral. And that's the trifecta that most don't have. Most don't have good revenues on tax returns, good credit, and collateral. If they do, we'll move them to SBA. But most of our customers do not have all three of these. If they have two, we move them to alternative SBA. If they don't have collateral, if they do have collateral, well, then we consider them for SBA loans, and those can pay you 0.5% as well, and usually the loan amounts on those are much higher. Credit lines, almost everyone you talk to wants a credit line. To get a true credit line, they've got to have qualifications pretty similar to SBA. They've got to have collateral. They've got to have excellent credit. They need to have financials. It's changing with some programs where they don't need collateral. Again, if they have good credit and good tax returns, then there's a good possibility they can get a line of credit. Sometimes they'll want a P&L, balance sheet, etc. Their net profits for the last 2 years will determine the loan amounts in a lot of cases, so how much they actually claim on profits on those tax returns. So we talked about the first C, cash flow financing. If they've got, they could get bank statements to verify their income. Credit doesn't matter. Collateral doesn't matter. Based on credit and risk, depends on what tier they're in. It depends on the rates and terms they get. PG, business credit reporting, all that stuff becomes available with low risk. Okay, then if they have tax returns and they have good credit, well, then that opens up all kinds of options. They have the credit line. They've got SBA loans, alternative SBA loans, private money loans, a lot of different options available. If they don't want the SBA process, we could expedite it and send them through an alternative source, and we could fund those up to, I don't know, we've got $32 million deals in our pipeline right now. But the higher the loan amount, the harder the deal is to close. So when you start to get to 2, 5, 10, 20, 30 million, man, these things could take 3, 6, 9, 12 months to close. Okay, but we have them, they're available, and some customers get a multitude of these different funding options as well, like this one. So credit-based financing, if somebody has, I say 700 plus credit scores, they can get 0% business cards. This has now changed. They can now get this with a 685 credit score instead of 700, and this is about a 660 credit scores. They can get personal cards, and I'm going to show you exactly what that means. So personal cards, these are personal credit cards where the funding source gets them about 5 times the amount that the customer would ever get trying to apply on their own. They can usually get about 10 to 150 grand. How much they get typically is about 5 times the amount of their highest credit limit account. Now I have to give all kinds of disclaimers here because of about 2 or 3 partners that send in customers that do not meet the qualifications I'm going to tell you, and then complain because they do not get 5x of what they would normally get approved with. We see people that don't meet the qualification criteria that I'm going to show you still get approved. They just won't get 5 times the amount that they norm of their highest credit limit account. They may get 2 times. They might get 3 times. They might not get approved at all. So again, for them to get 5 times the amount of their highest credit limit account, they're going to have to be spot on with these qualification requirements I'm going to show you. If they're not, they might not get 5 times. So that means if your highest credit limit account that you have on your credit report now is 10 grand, you can get about 5 times that with this program, about $50,000, and you can get this even as a startup. Now, these first cards I'm going to show you do report to consumer credit reporting. Obviously, you and I don't like that. We want business credit reporting, but they're also easier to qualify than the business accounts. They're usually getting 5 business credit cards, not 1. One credit line requires tax returns. This is no doc. There's no tax returns. There's no bank statements. There's no income verification at all. It's the difference between full doc and no doc. Credit lines are full doc. They go full doc. They provide financials. They can get a credit line with good credit. If they have even average credit, they can get this program with no income verification. It's no doc. And instead of getting 1 high limit credit line, they're getting 5 credit cards. Okay, still can get 50, 150,000. It's just broke up into 5 cards, and that works for them because it creates competition. If we get them a small community credit union credit card, and then we get them a city credit card in their region, well, then those companies see each other, and it's easier for them to give the customer higher limit increases in the future because they see those other accounts reporting. They're usually getting 0% intro for 6 to 18 months, great for startup companies, 5 to 25% normal credit card rates basically after that, and they're usually going to pay they're always going to pay a fee. And this is very important. Your customers should know this. We don't charge a fee. We don't charge a fee on any program at all. Some loans we don't even get paid on. But the bottom line is the funding source in any kind of loans that we do has fees, right? That's how they get paid. It's normally 9 to 12%. The industry normal is about 12%. We have our sources will go even as low as 8% or 9% fee on this because we send them so much volume. You can make more if you charge more. So basically, it kind of works out where, I don't know, it's a tier system, but the lender keeps about 5%, and then we can split up a lot of the difference. So if they are getting 12%, for example, and if we're charging them 12%, well, then you could make about 3 points, maybe even more on the deal because we get to keep more. If we're charging them 9%, well, then you're only making about 2% on the deal because the lender's only paying us total 4%. Remember, we're splitting it with you. That's how the fees work. You guys have the customers. You bring the customers in. We do all the work, get it approved, go through the whole process with underwriting, get the deal funded, and we basically get paid and split it with you if you're part of executive. That's just how it works with almost all the funding programs. So on this, you're going to make about 2%. If they're paying 9% fee, if they're paying 12%, you could make 3%, maybe even a little bit more. So pretty good program to be able to get paid on this. You're going to, and this fee is rolled into the cards they get, just like SBA. They roll the fee right into the loan amount they get. So if the customer comes in and gets approved for 1 credit card for 10 grand, then when they get that credit card in the mail, they get an invoice for the 10 grand, and then they get an invoice for, let's say, $900. They use that card typically they got to pay the $900 fee. That's exactly how that program actually works. Okay, so again, they're paying a success-based fee only on what they get. I had a client that I put in the other day that he was a guy that had me on his podcast, and he said, I don't want to get approved for 150 grand. I only want 90. So they're able to limit the amount of money that they want to get approved with when they talk to the lending source as well. They've got to have about a 650 credit score or higher for this program, utilization under 50% on their current credit cards, less than 8 inquiries on their credit in the last 6 months. One of the best ways to get people money when they don't have cash flow and collateral. Now, here's the better and it even works for startups, and this again pays you 2 to 3 points. I broke down how that works. This is the better program. When you bring somebody in that has average or better credit, we're going to try to put them on this program first. But if their credit's not good, that's when they're going to be offered personal cards. You get approval limits from 10 to 150,000, 5 times the amount of their highest credit limit account. These report to the business credit reporting agencies. So let's think about this for a second. When we talk about the steps to build business credit, one of the initial steps is to get 5 vendor accounts, right? Well, they could literally skip that step with this program because we're getting them 5 cash credit cards. They do require good credit. They do have a personal guarantee, but those accounts report to the business credit reporting agencies. So not only is somebody able to get up to $150,000 in funding, even as a startup, no doc, but they build their business credit at the same time with 5 cash high limit accounts. And we also know with business credit building that the future business credit account limits they get are pretty equivalent to the what's on the report. So if you're adding 5 $10,000 accounts to somebody's credit report, well then guess what? You know, all of a sudden they're going to start getting the next round of business credit accounts at $10,000 because we just built their business credit with these 5 accounts. So I tell people all the time, now when I teach about business credit building, I now talk about this option. You have a couple options if you want to build your initial business credit. You could do it with vendor accounts. You could do it with this option as well because it helps them build their business credit. They get money and build their business credit, which is awesome. They get the 5 cards, creates competition, 0% for 6 to 18 months, and also very perfect for startups. Same thing, same fee. They need a 685 score or higher. Utilization 30% instead of 50 on the personal cards. 4 inquiries in the last 6 months versus 8 with personal cards. And one of the best amounts to ever get somebody, even as a startup. I love this program. Absolutely love it. And our customers do too. The revenue lending and this program combined, 85% of the customers that we fund get one of these 2 programs. It's not to say that that doesn't mean that only 15% get the rest. A lot of them get a collateral and this program. So a lot of them get multiple funding products. Keep that in mind. But of the customers we fund, 85% of them take one of these 2 products. That's why I have so many slides on them. That's why they're so important, because you've got an option for somebody with good credit. You got an option for somebody with bad credit, and somebody with good credit or a guarantor. A guarantor will work. If they have a friend, a family member, somebody else in their business, a colleague, somebody that's a partner, those people can sign as a guarantor that have good credit. Maybe they both sign. Maybe the owner and a guarantor sign, and they get a lot more money with 2 borrowers. But again, it's usually about $150,000 per entity, per corporation, LLC. If they're adding a guarantor, the guarantor will get added to the business as an officer during the process. They can get removed when the process is done, but they need to be there to be able to actually qualify to get the credit for the business. Okay, that wouldn't apply on the personal cards. So I show you the business and personal cards for 2 reasons. As you see, personal is much easier to qualify. 650 credit scores, 8 inquiries, 50% utilization. People that don't usually get the business cards can also be offered consumer cards, and that's how the approvals come. They might say, look, we understand your highest credit limit account is 10,000, but instead of 50,000, we're probably going to be able to get you 20 to 30,000 in business cards and another 20 to 30,000 in personal cards. Well, if you see an approval like that, the reason is because they didn't meet this qualification. They had too many inquiries. Their utilization's too high. And we sometimes have that. We have some partners say, hey, look, you know, I was told 5 times. Yeah, but you're also told utilization below 30%. This customer, we saw one that the customer had a 70% utilization on an account, and the partner wasn't sure why they didn't get 5 times the amount of their highest credit limit. Well, according to this, they shouldn't even qualify, but we were able to get them approved to get them 3 times the amount of their highest credit limit. They just couldn't get 5 because, again, the problem was they were overutilized. So sometimes if they're borderline, they might not get 5 times the amount, but they could still sometimes get approved depending on the risk. And now we've got kind of consumer credit reporting cards, which work with, you know, average credit, and then these for people with good credit. Okay, collateral-based financing. Any type of viable business collateral, some types of personal collateral will work. Here is basically the collateral that can qualify. Account receivables, purchase orders for a business, a book of business if they're an insurance agent, equipment, inventory, commercial real estate, even commercial vehicles. We've got some financing done on commercial vehicles, ambulances, buses, etc. Acceptance acceptable personal collateral? Do they have stocks? They have bonds? They have other securities, IRAs, 401k? Any of those could be added. When we look at these, account receivable financing is pretty popular. Book of business financing is really popular. If you're dealing with insurance agents, this is definitely one you want to promote. We do a lot of equipment financing. We do a lot of 401k financing. We do very little of the rest. I think we have closed stock loans, not very many. Commercial vehicles, pretty rare for us to have those customers, but we do see them. Real estate, we're doing more of. We've got a lot of new sources, so we're doing a lot of stuff there. Inventory, I've never seen one of these close because they need a $500,000 in inventory to qualify. A lot of our customers just don't have that. And purchase order financing, we see some of those too. But AR financing, book of business, equipment, and 401k are probably the most popular out of this. So account receivables are used as collateral. So if you don't know what a receivable is, I'll give you an example. I'll give you an example of a real client we funded. I always remember this because it was one of my first finance suite sales ever. He owns a factory, and he basically does the plastic mugs at Busch Gardens. So, Busch Gardens wants to order 10,000 plastic cups that they sell to you for ungodly amounts of money. Then he's the one that makes those plastic cups. He's the one that actually physically makes them. But when he gets an order like that from Busch Gardens, he's expected to produce the order, give them the order, and wait 60 to 90 days to get paid. So by the time he gets the order, produces it, and gets paid, could be 3-4 months. Well, AR financing gets him 80% of that money that's owed within 24 hours, and then the AR source collects from the actual customer, and then when they get paid, they end up paying him back. Guys, and sometimes it's weird because the biggest objection with AR financing is the customer says, well, I don't want the funding source to collect. How will that make me look? Well, it'll make you look like not a small company, because all really big companies use this. Johnson & Johnson is one of the biggest companies that deals with AR, and they don't handle their own receivables. They let the other AR lender handle it. That's the way that business is done, especially with large companies. So loan amounts of $5,000 to $20 million. They get up to 80% of that money from that invoice advanced to them within 24 hours, and then they pay a 1.25% to 3% discount fee, and from the money that is kept, from the 20% that's kept, and then they give them the 20% minus that discount fee whenever they get paid. So for example, my buddy, he gets an order from Busch Gardens worth 10 grand. He went through this program as an example. He gets 8,000 sent to him from the lender the next day. They keep 2,000. Then when the deal funds and Busch Gardens pays the lender, then they give him his 2,000 minus the 1.25% to 3% discount. Usually there's a 4% fee in the very beginning, the first time they do it. No credit score requirements to qualify on this program. Receivables have to come from a business or government. They can't come from an individual. So if you're a credit repair company that has customers that owe you, for example, that won't work because you have customers. Your customers aren't businesses or the government. You got to be open for 1 year to qualify. Medical receivables, construction receivables are very common, and conventional receivables are beyond that. So what do I mean by this? I mean, this is the most popular industries. It's doctors' offices that are collecting on Medicare, Medicaid, and insurance from health insurance companies. Now they don't have to collect that. The lender does it, and they don't have to wait for the money. They get it right away. Another is construction contractors, right? The plumber that does all the plumbing in the houses that U.S. Home is building and then has to wait months to get paid. Those are the two most common industries for this, but it works on a lot of other industries beyond those two. But if it is medical, they need to have about 600,000 annually in sales. The nightmare is so big to collect on health insurance from health insurance companies that lenders won't even touch them unless they do that. And this pays you about 0.5%, but it's recurring money, which is cool, which means that basically you're going to get checks ongoing about every month. They're not big checks, but once people get into AR financing, they don't usually want to come out. So what that means is it means you're going to get checks consistently when that money actually comes in every single month. When they get funded again and again, you continue to get paid, which is cool. Purchase order financing, $5,000 plus in purchase orders. Up to 95% of the purchase order can be advanced. The 5% less the fee is released once the invoice is paid. So let me give you an example of PR, or this one. I always use the same example. I don't know why I need better examples. Let's say you're a t-shirt embroidery company, you get a huge t-shirt order, you have to buy the t-shirts, you don't have or don't want to spend the money to buy the shirts. So you have a PO lender come in, they pay the shirt supplier gives you the shirts, then you embroider the shirts, deliver it to the customer, then you get paid. So that's exactly, or then the lender releases the rest of the money to you. So basically you're getting the money to buy the supplies you need to fulfill the product. 1 to 4% rate on this, no credit score requirement for this or AR financing, and they're getting a letter of credit issued to the supplier to notify them that that the money is good, so they ship the actual product to you. And it cannot be unfurnished goods, and all you really need is a application copy of a purchase order. This pays you about 0.5% as well. Book of business financing, commissions are used from an insurance agent's book of business, must only be an insurance agent. This is one of the best loans I've actually seen. It's a 3 to 10-year loan, and the interest rates are pretty low on this as well, 4 to 9% plus the prime rate. They only need a 520 FICO score or higher to qualify, and they can get 120% of the surrender value of this. So what's that mean? Well, if I'm an insurance agent, and let's say I'm a Geico agent, and I'm going to sell my book of business back to Geico because I'm retiring, that means I'm surrendering my book of business back to Geico. Whatever Geico would give you on that's your surrender value. You can usually get 120% of that amount. It's high. To date, I've never seen one customer ever get the maximum amount they could get. Every customer gets a smaller fraction of what they could get, meaning they want 50,000, we can get them approved for 200, and they're like, no thanks dude, I'll only take 50. So the loan amounts on this is very, very high. No State Farm agents because they don't actually own their book of business. These, like almost all collateral based products, usually pay you about 0.5% on average because we make about 1%. They can buy new equipment, they can lease new equipment, they can borrow against equipment they already have with equipment financing. Financing and leasing is available. Leasing is not available for a startup. It's available for a business that's been open 1 year, but financing is available for a startup. 10,000 to 2 million, 12 to 48 months loan term, 5 to 55% low risk, high risk. It's all over the board. 580 credit score or higher, 650 is preferred with equipment financing. 2 years time in business for leasing. I just said 1 year, it's actually 2. They can borrow up to 50% of equipment that they already own. Startups can get financing for initial equipment, and this could pay you 1 to 3 points. So I just talked about a lot of different things here, and let me kind of break it down. So let's say I have somebody that owns equipment free and clear. They could borrow against that as much as 25, 50% of the value of that equipment and get a loan. Okay, so and a credit isn't as big of a factor. So if they have a backhoe that's worth 50 grand, well, then they might be able to get approved for 25 grand using that backhoe as collateral. But let's say you have a brand new startup. One of my friends, we got her funded. They have a medical facility, and she needed all kinds of like weird X-ray equipment, and we got her funded. Actually, I'll get to you a good story with her. What we did was got them unsecured financing and equipment financing. So with equipment financing, they usually want the first 2 months payments as down payment. We got them unsecured financing. They used the unsecured cards to pay their payroll, to pay their down payment on this program, and then we got them equipment financing even as a startup to get that X-ray equipment, and they were ecstatic. They were going to take all the money they had to use it to get the X-ray equipment. We said, no way, let's get you the money, keep the money, let's use only to cover your down payment on the equipment financing and get you equipment financing. Guys, that's what you and I do that's awesome that no other source does. Because we deal with all these kinds of financing, we can mix and match and get them multitude different types of financing products. You get paid on all of it, and the customer gets a lot of solutions that they can't normally get at one source because no one source beyond us offers all these programs. So inventory financing, $250,000 to $500,000. They get a line of credit. Personal credit doesn't matter. 2 to 5% rates, 520 credit scores or higher to qualify. They got to have $500,000 in inventory, and then they can get approved for 50% of that inventory amount. I love this because it's one of the only line of credits that's available that isn't based on personal credit quality. But again, it's not easy to qualify for because you have to have $500,000 in inventory to even qualify. Not a lot of people have that much inventory on shelves to be able to do that, and they've got to have a good inventory management system, and this pays you about 0.5% to 1% as well. Stocks and bonds, you can get financing for up to 95% or 90% of the value of those. It's a 5-year loan or a credit line, which is fantastic, and they're paying prime plus 2%. 6% interest rate, which is a really low rate. I say 500 FICO, but personal credit doesn't even matter with this. Most stocks and securities are accepted, and this pays you about 0.5%. This is actually a pretty cool option because somebody that has stocks, or let's say you have somebody that likes what you're doing and you can actually use their stocks as collateral, they could use their stocks to get financing to fund your business. So it might work for you, it might work for your customer, but either way, it's a really good option because, again, personal credit doesn't matter, collateral doesn't matter. They still keep their stocks in place. They still earn interest on the stocks and dividends and returns. They still get everything they would normally get. They're just pledging the stocks as collateral that would be taken if the customer defaulted. Commercial real estate, 75,000 to 20 million. Loan amounts 55 to 65%. They usually need 2 years financials, tax returns, P&L, etc. to qualify. They've got to have the cash flow to make the payments, kind of common sense, average credit, and then obviously they have to have a personal guarantee. Interest is pretty low, about 4 to 5%, and I've seen loans up to 20 million. We've got some lenders that'll do $500,000 start, some lenders will do 75,000. This will pay you about 0.5% to 1%. We actually have a lot of new sources for this. So if you have any kind of commercial real estate, we've actually got some pretty aggressive funders where we never have in the past, but we've actually got some pretty aggressive funders and products, and we're doing a lot of commercial real estate refinances and purchases. We can do both. Stocks and bonds, I already mentioned stocks, but I'll add in 401k. They can get up to 90% of what's in, I'm just going to skip that, up to 100% of what's in their 401k. 5-year loan, they can get prime plus 2%, 4.6% rate. Credit score doesn't matter. They are going to pay a $2,000 fee to the lender that gets rolled in. There's no penalties. It's a tax IRS proven strategy, so there's no penalties. And this pays you about 0.5% as well. We do a lot of this kind of funding. They still get to earn the interest on their 401k. They're just pledging. It's not really even a loan. It's more like a reallocation of funds is what they're doing. They're basically accessing their 401k to fund their business instead of using a 401k investing into other companies' businesses. That's basically how it works with 401k financing. So it's not a really straight loan, but we have a lot of customers that do it because they have a 401k, they can't qualify for money, and they're able to use that. I remember a bar where we got the guy approved for $750,000 in funding. He couldn't even get $25,000 at his bank, but he had a 401k, so he used this kind of funding. Of course, he didn't take the full 750, but he had access. And then, of course, business credit. Remember, we talked about the 3 C's. I just talked about how to get financing based on cash flow, credit, and collateral. Remember, business credit, the beautiful thing is if you have customers that have none of those, well, then they can still get business credit. It's the catch-all, right? They can get immediate vendor credit and high-limit store and fleet and cash credit cards, no personal credit check, no guarantee, no financials, no bank statements, works for startups, a cash credit's available, sometimes requires a PG. We've got multiple sources in the finance suite right now that don't. I maybe confused you and myself here. I usually talk about financing and business credit as 2 separate things, but the reason I put this here is the beauty of what you and I do is we can help everybody. A buddy of mine, one of our new sales guys, Jim, who just started working with us, he worked for a company that did lending. And the reason he wanted to come here was because we could help everybody and he couldn't. He could only help certain types of people. That's the beauty of what you and I do. If somebody has cash flow, we can help them. If they have collateral, we can help them. If they have credit, we can help them. If they have none of those, well, then they can still get business credit and we can still help them. And again, there are only reports to the business reporting agencies. Utilization doesn't affect the personal score. There's no inquiries with business credit. And it also determines if they'll get approved for a loan, the amount they'll get approved for, the terms of the loan they get. So a lot of benefits. But again, the beautiful thing is that when you're pre-qualifying customer and you have somebody that doesn't have cash flow credit or collateral, well, business credit's a catch-all. We can still help a lot of those people. So Patrick just asked, can you get a loan against an annuity? I don't think you can, but if you would do me a favor and email me that question, ty@creditsuite.com, ty@creditsuite.com, because I don't remember the answer to that, Patrick. I don't remember. I don't think we can on an annuity, but email me that question because it's a good question that I'm not positive on, and I don't like to guess on stuff. So if I don't know, I don't know, and I'll be the first to tell you I don't know. But what I will do, actually, you know what? Let me see if I can find that out right now. Can we get financing against an annuity? Give me a second here real quick. And give me 1 second. Let me find this out. text Dex Mobile, can we get financing against an annuity? I'm going to find out right now. I'm going to have send. All right, so Suri's going to find out for us. She's going to text Dex right now and see if that's possible, and hopefully before we even get off this, I will be able to have an answer for you on that. Let me type in a question mark here just to make sure, because Suri does some weird things. Okay, is there a way to get the recording of these webinars? I'm usually at work during the broadcast. Yeah, all of our weekly webinars, guys, are recorded in your back office. They all are. They're in your back office. I'll show you, because I get this question a lot. I'll actually show you exactly where they are. But first of all, the most recent one that you have is actually the most recent one you have is always on your home page in your back office. So this is your back office home. This is the last webinar from last week. You can register for the webinar. You can watch last week's. If I go to partner resources and I go to live training webinars, all of our webinars are here, and not only can you get these here, you can see all of them here. You can also break them down into finance, business credit, training, sales, into categories, which is pretty cool. So it's very easily accessible right here. We usually have them up about 24 to 48 hours after the original event. And so that's it. And Patrick, I might have to email you back. Send me an email, because I still haven't heard back from Dex on this. So if you have any other questions, please type them in and let me know. And so I can, and I'm going to try texting them real again. Can we fund against, and I'm going to text them again, because I am not sure if Suri sent him the first one. Let me see here real quick. I'm just trying to get a real quick answer. So I'm going to try to find out an answer here for you. But if anybody else has any other questions, go ahead and type them in. Let me know. I want to make sure they're answered. So now you have a pretty good idea of a lot of changes, a lot more funding programs we're going to be adding here in the weeks and months to come. And I will keep you informed of new products as they roll out. Remember, if you're not already part of Executive, you can go to creditsuite.com/executive, and you can get all the information on that. There's a pretty cool video here. If you go right here to click to learn more, this explains and shows you everything in the back office. And I know this is really ugly, this click to call. This is something new we're trying. But this is something that will go through and show you everything to do with the Executive program. There's a ton of access you get, and you get the ability to get paid on funding. So if you're not already part of Executive, it's worth it. We've switched everybody over to Executive, even the people that were paying $2.99 a month. We knocked you down to $99 a month and gave you all the privileges and more. So it's pretty cool. It's worth checking out, creditsuite.com/executive. I'll send out an email about that as well. I'm not hearing back from Dex. So Patrick, go ahead and email me and I will get you that answer. I don't have any other questions. Somebody says, what is possible commercial vehicle? What percentage fee on securities loans? The possible commercial vehicles, I put that in there because we were testing it at the time, but we've had some success with that. So I'm now comfortable saying that we can do commercial vehicle financing, but we don't have a lot of sources. So it really depends on the type of vehicle. Like you can't have like a trailer that you haul a boat on, but like 18-wheelers will work in some cases. We have ambulances that will work, and buses, and some of those commercial vehicles will work. We have funded them now, which is why I'm still not funded enough to say to remove possible, but that's what I mean. And what's the fee on securities-based loans? They don't typically charge a fee. It's just the rate that they charge. Like 401k, they do charge the $19.95 fee and roll it into the actual loan. We don't see that on the securities product from what I have seen. And they can get 90% of the securities, and I already showed you the percentage over prime on that. But let me pull that up because I can't remember exactly what that percentage over prime is. So let me pull that up real quick. So yeah, it's about 2% plus prime, usually 4 to 6%. So hopefully that answers that question. Can you fund commercial real estate? Yes. Storage units? Yes, we can. We have a lot of really good sources for commercial real estate and some programs that are really exciting that our customers absolutely love. So absolutely we can. Anything like on that, you just want to send over an FBQ. And then if you send over an FBQ, then from that point, we can get you an answer on that fund. And I'm going to actually email one more of our finance officers to see if I can get an answer on this before we wrap up as well. So yeah, great, Alan. If you haven't, I've always never really talked about commercial real estate financing a lot before because we never did a lot of it and we never had a lot of great sources. But that being said, we have a lot of new sources, including one that we're really pretty passionate about that we can do. So whether you're looking to buy or whether you're looking to refinance commercial real estate, we have sources that can absolutely help with that. So I'm going to go ahead and wrap this up. Patrick, I still haven't heard back, and you know what's going to happen is the minute I end this webinar, I'm going to hear back from both. But email me and I will get you an answer on the annuities. And if you remind me next week, then I will go ahead and also tell everybody what the answer to that is. No other questions. I'm going to go ahead and wrap up. So a lot of great information today. Hopefully you thought a lot about the financing programs, what's changed, what's new for 2017, the fees you can earn, et cetera, et cetera. Remember, if you have any questions about Executive, now you know what your customers can get. But if you want to get paid on the funding deal, you no longer need to pay the $299 direct funding fee. We have killed the $299 funding fee. Nobody's paying it. Everybody that was, we've removed your payments and moved you down to $99. I already notified you of that. This is the same as the silver subscription. We've always had the silver. If you weren't paying it, you sneaky person, you were supposed to have been. But what we did was we put it into subscription. Everybody else was normally paying in silver and put it here and just gave you a ton of benefits, including the ability to get paid on funding. So if you have any questions, reach out to us, support@creditsuite.com. We'll talk to you a little bit more. And there's a cool video at creditsuite.com/executive that walks you through the program as well. I'm going to wrap this up. No other questions. Thanks everybody very much. Have a great day today. I will talk to you all next Tuesday here at 3 o'clock. Thanks everybody. Have a great day.